Imagine you're standing on West 43rd Street, staring up at the national debt clock. The numbers are spinning so fast they're almost impossible to process. $38 trillion. $39 trillion. Now forget the abstract trillions for a second. Think about your life, your paycheck, your mortgage, your 401k, the savings you've been building for years, just in case. Now here's the uncomfortable question. What if the real plan isn't to pay off the debt, but to devalue your money? In 2025, something historic continued. The federal government paid more in interest on the debt, $970 billion, than on national defense, $917 billion, more than the military, more than many core programs. Just servicing the debt approaches $1 trillion per year in 2026. Now, this isn't a theoretical problem. This isn't someday. It's happening right now. And here's what that means for you. When debt gets this large, around $38.84 trillion today, a country enters a debt spiral. To pay the interest, it has to borrow more. To service the new debt, it borrows again. It's like using one credit card to make the minimum payment on another. Except this isn't your household. It's the largest economy on Earth. In theory, there are only three ways out: austerity, raise taxes dramatically, or slash spending. Default, simply say, we're not paying. Inflation, repay the debt with dollars that are worth less. Let's be honest. Can you picture a politician cutting Social Security by 30%? Or a president raising income taxes to 70%? That's political suicide. And default. If the United States defaulted, the global financial system would freeze. Banks, pension funds, the dollar as the world's reserve currency. Everything depends on trust in U.S. Treasuries. That's the financial nuclear option, so that leaves the third path. And it's the one every empire in history eventually chooses. You don't refuse to pay. You pay. In full. On time. But you repay with money that's worth less. Here's the simple math. If the debt is $38 trillion and inflation runs at 5%, the real value of that debt shrinks by $1.9 trillion in 1 year. No tax hikes, no dramatic vote in Congress, no screaming headlines. Your dollars just quietly lose purchasing power. And that's the strategy. Think about your savings account. If your bank pays you 4%, but real inflation is closer to 7 to 8%, you're losing the difference every single year. No visible deduction, no bill in the mail, but your purchasing power shrinks. In effect, you're helping melt away the national debt. Here are three mechanisms changing the game. In a true free market, a government this deep in debt would have to pay 8 to 10% to borrow. Investors would demand compensation for the risk. But banks, insurance companies, and pension funds are required by regulation to hold government bonds, not because they're attractive, because the system demands it. Demand is manufactured. Rates stay artificially suppressed. Your Social Security benefits are tied to CPI. Inflation-protected securities are tied to CPI. The lower the official CPI, the less the government has to pay out. Since the 1980s, the formula has changed. Substitution. Steak got expensive. Eat hamburger instead. Hedonic adjustments. The car costs more, but it's better quality. On paper, inflation looks lower. In real life, you feel something different. In the past, the Federal Reserve fought inflation aggressively, no matter the cost. Today, it's constrained by the size of the debt. If rates were raised to 10%, like in the 1980s, interest payments alone would exceed total tax revenue. The system couldn't handle it. so rates are held lower than economic reality would normally justify, and that means longer, stickier inflation. When the Fed creates money, it doesn't mail equal checks to every American. The money enters through the financial system. Banks and major institutions get it first. They buy assets, stocks, real estate, tech companies. By the time that money reaches your paycheck, prices have already risen. This is the Cantillon effect. Those closest to the money printer benefit first. Those living on wages fall behind. That's why since 2008, the economy has taken on a K-shape. The top 10% see explosive asset growth. The bottom 90% see purchasing power stagnate or decline. For decades, the advice was simple. Work hard, save 10%. Invest in a 60-40 portfolio. Buy government bonds. That strategy worked in an era of stable money. In an era of fiscal dominance, it guarantees a slow loss of purchasing power. Now, just to preserve your wealth, you're pushed into risk, stocks, real estate, crypto. The economy starts to look like a casino, where choosing not to play means slowly losing anyway. Physical cash is your exit. You can withdraw it. You can step outside the system. But what happens if the dollar becomes fully digital? A central bank digital currency would allow negative interest rates applied instantly, automatic deductions from your balance each month, expiration dates on money, transaction restrictions. No cash means no exit. And this isn't science fiction. Versions of this are already being tested in other countries. The United States is not going to declare default, but the full purchasing power of $38 trillion plus will never be repaid. It will be erased through inflation, slowly, orderly, bureaucratically. The winners will be those who hold scarce assets. The losers will be those who trust only the currency. The American dream of save your way to safety is changing. We're entering an era of asset survival. And here's the real question. If the rules of the system are changing, can you afford to keep playing by the old ones? Because the debt is disappearing, but it's not disappearing for free. Someone is paying for it. And if you change nothing, there's a good chance that someone is you. What hidden cost of debt have you felt? Comment below. Subscribe for more strange money paradoxes.